we're still in the early innings of this bull run.
We're not overheated at these levels.
I do think there is considerable further upside in the lithium space.
The drill results were really important to determine the continuity of the resource. We found new higher grade areas, both extensions towards the east and also at depth.
Welcome back to our weekly Rockstock recap. It's Thursday, April 30th, and today we're going to do things a little bit differently. After the recap, we're tacking on our latest interview with John Passalacqua of First Phosphate, a company we've been highlighting as one of the few pure plays on phosphate for LFP, a theme that's quietly gaining traction alongside everything happening in lithium and batteries. And First Phosphate has been pushing all-time highs of late, so we'd encourage you to hear from John. We'll also tack on, Matt did an interview with Amy Rotman at mining.com.au, where he talked about CATL quite a bit, which had some major announcements this week, including sodium ion, which we'll speak about as well. In addition, Matt just published, first in a while, an RK Equity research note on a formal 40 page note on NOAA lithium brines titled "The Market Fails to Understand NOAA's Optionality," which really speaks to the broader theme we're seeing across the sector. High quality brine assets in Argentina still trading at significant discount despite advancing toward pre-feasibility and scaling some of the largest undeveloped land packages in the lithium triangle. Beyond that, we're going to go through the RK Equity scoreboards, talk a little bit about the latest lithium earnings and quarterlies, plus Matt's key takeaways from being on the ground at a key conference in London this week. We'll also circle back to our first RK Equity quarterly Patreon webinar this week. And for those of you who joined, thank you. We published, that was a free webinar. We've published this as a video. We'd encourage you to watch that. And also would encourage all of you to visit patreon.com/rockstock channel to understand our bronze, silver, and gold tiers and what you will get, including this bespoke webinar and other research from Rodney, Matt, and myself. A few people asked some questions in that webinar. We didn't have time to answer those then, so we're going to answer a couple of those here today. And finally, just a quick note that Rare Earths Americas published or filed for an IPO. There was a Reuters article targeting roughly a $368 million valuation. This is going to be a U.S. listed IPO. They have assets in the United States as well as in Brazil. But more broadly, this is another signal in our view that the capital markets are wide open for strategic critical mineral stories, particularly in tier 1 jurisdictions like the US and Brazil. So with that, Matt, Rodney, let's get into it.
Well, shall I kick off? Let's maybe talk about the scoreboards, because there was some pretty major differentiated performance in the space over the last month, and indeed, over the last year or so. So, what stood out for you, Rodney?
I think what looks to be the case, Matt, is that potential development companies seem to be on the up, because finally we're having some consistency in prices that seems to be prolonged. And then I guess one of the things that's, I've noticed for a while that no doubt is coming up in your note, and we're seeing, is often what you find is there are effectively two mines for a lot of these long life brine companies. So a lot of the time they aren't valued. You just get the first pre-feasibility where there's a cap out in production and then 20 or 30 years, but there's always effectively another mine life on the back end of them. So it'll be interesting to see when those valuations start to get noticed. But we saw in the results, and I'm keen to hear your thoughts on this, a bit of variation in the average price received from some of the spodumene producers. What do you think, Matt? How's that happening?
Yeah, I think that's very interesting. Obviously, they're all selling products at different grades. So, I think that's the key aspect that stands out. They're all selling products at different lithium oxide concentrations, and with slightly different sort of impurity profiles. So they are going to trade at slightly different prices. Some of them are coarser, some of them are finer. That also makes an impact. They're shipping from different places. So they're going to have sort of different shipping costs and at different sort of frequencies. So all of those factors are going to have an impact. But the magnitude of the differences in some of the producers was pretty substantial. So I think I've seen people pointing out that IGO's realized prices were quite a lot lower. And I guess it kind of comes back to, in some cases you've got the impact of provisional prices. So that's where the companies sell at one price and then lock in the higher price when the product is delivered. And you've also got lots of other impacts in terms of when in the month the shipments were made, whether it was in a high price period or a low price period. So it's going to be quite interesting to sort of see going forward. And I think one of the big losers among the big Australian players from this reporting period was certainly IGO. And fair to say that the Greenbushes production data was pretty, I would say, on the disappointing side, in terms of what's coming out of that mine. A lot of people in the market flagging lower grades than expected, lower head grades. So I think, all is not looking well at Greenbushes. It's still a huge asset. It's still a huge producer in the market, but is it as good a mine as it was maybe 4 or 5 years ago?
Yeah, that's a good question, and I guess that's what was flagged up. And then your thoughts on Elevra, because that share prices seem to like the operational leverage that they enjoy.
Well, I think you've laid the nail on the head there. It is the financial leverage. So this is a high cost asset, and the move upwards in commodity prices therefore is amplified because you've gone from making very little profit or making a loss to making quite a substantial profit in the course of 2 or 3 quarters, which sort of amplifies, if you think about PE and the impact of earnings on price, that amplifies the price reaction, and that's what we've seen in the stock. I mean, up 64% for the month is quite a substantial move. So,
well, credit to them. If you remember, and Howard, you'll remember, is that they kept producing when times were, was touch and go, and they kept going. So credit to them for keeping the faith.
And I think what's interesting is they are continuing to sort of focus on costs. They're focusing on recovery. They're sort of bringing improvements through the plant. So they're not sort of sitting in their laurels. They are continuing to, improve what they're doing at that operation, even though prices are very high. And I think, that's good to see from a management team. And I guess the final stock to flag in the hard rock space would be the Sigma Lithium, which also had an absolutely cracking month, up 73% in local currency terms. And, obviously Sigma has been through tough couple of months over the last sort of 5 to 6 months. They had to switch the mining from contract mining to owner operating. They restarted production midway through February, I think it was. They've been ramping up from there, hopefully realizing lower costs. And then, the news flow about the stage 2 and stage 3 of the project. And I think you've had a lot of investors come in and said, well, fine, hopefully the bad news is out of the way. Let's go ahead and buy this stock. But interestingly, it's trading at a $2.3 billion market value compared to Pilbara at 13.5. So, is there still upside in there? Well, You decide.
I think Liontown is a good comparator as well. Liontown is at a similar stage of production, I think, as Sigma. And Sigma, if you look at what Liontown has forecasted for their growth, and Sigma, what they have forecasted for their growth, with stage 2 and stage 3, they're not dissimilar, but Sigma's trading at more than half of Liontown's valuation, with less debt.
And of course, Liontown is now fully underground and therefore that much higher cost than Sigma is. I mean, Sigma's got, an operating cost which is right down there in the bottom of the first quartile in terms of hard rock operations, and probably on the edge of the first quartile in terms of the whole industry. So, you really are not comparing apples with apples when you look at their sort of cost profile.
Yeah. Could you scroll down to the emerging producers a bit? Because I want to call up Q2 for a second, because Q2, just as we're speaking, is on the tape, raising money at raising $60 million. And I was just looking at the pricing of it. So the price, they're raising $40 million through a regular placement at $2.45, and $20 million through flow-through shares at $3.60. So basically 1/3 flow-through, 2/3 regular. And if you do the average price of that, the weighted average price of that, it equates to $2.82. I was just looking at the price, and it was $2.82. I don't know. It shows $2.75 here on our scoreboard. I'm not sure if that was priced, yesterday or the day before. But it looks like they priced it exactly at the close yesterday. No discount, no warrant, no half warrant, no nothing. So congratulations to Q2 at an all-time high, top ticking, no discount, which speaks to the quality of that discovery, or the MRE, which we discussed, at length, last week. But just hat tip to them. And you wanted to speak, I think, as well about some of the brines, not just the hard rocks on the lithium scoreboard.
Yeah, I did. I mean, one of the big winners, one of the other big winners this month is Galan Lithium, which is obviously, pushing up towards project start for the first stage project, and it was up 55% for the month. And it's great to see the sort of brine area attracting attention. One of the things that I flagged in my webinar is the massive discount that the Salar brine companies are trading at compared to hard rock companies. So whether that's a producer like Lithium Argentina, or a developer like Galan, or an earlier stage developer like Noah, they're all trading at a really, really material discount to their hard rock peers, which to me doesn't look justified. And if you look at the sort of takeout prices that have been announced, that have gone through for brine assets over the last sort of 12 to 18 months, you can tell that industry really likes brine assets. They really like the optionality of brine assets. But it seems that the market hasn't quite woken up to that as a reason to buy them yet. So, we've got however many it is there, 8-10 brine companies featured in the scoreboard. And, there's a mix between high quality and low quality, or high grade and low grade brines there. But certainly for the higher grade brines, you should think that they should be trading at a premium, and they're not. They're trading at a huge discount. So
Matt, would that be a fair lead on to say that is likely where, I mean, we've had historical M&A in that area. It's likely we're going to have more M&A, and that's the place to be buying.
I mean, for me, the attraction of a brine asset is, if you look at the resource base, they're big resource bases, or for the bulk of them they are. That gives you the optionality to extend production. They're scalable, as I said, and they're also mostly in the bottom half of the cost curve. And if I'm an industry buyer, I want to buy assets that are in the bottom half of the cost curve. And I don't think that the equity market is correctly valuing that.
I mean, is there any thought, your thoughts on why? Because historically we've seen deals and we've seen great valuations in that sector. Is it a geopolitical thing, or is it just...
I think there's a couple of issues at play here. I would say that the bulk of brine assets are listed in North America. And I think for the most part, North American analysts are quite negative on the lithium space. So I think that's one of the reasons. I also think that there's a lack of understanding of lithium brines in the North American market. In Australia, brine and hard rock sits in the mining space. In North America, it sits in the chemical space. And these are all very, relatively small companies compared to the sort of big chemicals producers in North America. And they're not really being picked up to the same extent. So I think, it makes for valuation inequalities, which are valuation opportunities as well.
If I could chime in here, I mentioned recently one of my new mantras is kind of go long where memories are short. And if I can go down memory lane a little bit, and also for our viewers, a lot of whom have followed us for many years, but many may be new, this scoreboard that we're looking at, I started creating like in 2017, and it had, I don't know, 10 or 15 names on it at the time. And by 2016, 2017, and by the way, these scoreboards are published every month. We have 15 of them. We put them out on Twitter, and they're attached at the back end of the Lithium-ion Bull, which we email out every month. If you're not already getting that, please register your email at rkequity.com so you'll get it. But this is a lot of investors have come to us and thanked us for these scoreboards, saying it's a great starting point every month or whenever you're looking at the space to understand what is the investable universe for this thematic, for lithium and the other critical minerals. But going back to 2015, 2016, 2017, sentiment in North America was good for lithium. And Macri had just come into Argentina, and everyone had great enthusiasm for what, that would be. And there was this whole argument that brines are lower cost, than hard rock, which they are. Once you're in operations, they are hard and they take a long time to get into production. But there was definitely a preference for brines in Argentina under a geopolitical regime that's not anywhere near as good as what we have under Malay at present. And if you look at the history of, and I'm going to write about this in future, just articulating, there's been as much or more M&A in Argentine brines than there have been in any other location, except for maybe, Western Australia, but I think it's probably similar. And those valuations, including Rio's purchase of Arcadium at $6.7 billion, included purchases of companies like Galan and like NOAA at billion-dollar valuations, including Rincon by Rio Tinto and Zijin of Neo Lithium. So it's interesting. You did just put out this note on NOAA. I'm looking at the scoreboard. It has a 43 million market value. That's 1/10 of Galan's at 468. They're certainly, much further behind Galan, but Galan, and if you scroll up, if you look at kind of like Lithium Argentina, Matt, is now it's now 1.5 billion. So it's five times. Lithium Argentina is 5 times the valuation of Galan. And we think, and we've been articulating, you have said Lithium Argentina and Sigma are crazy cheap relative to its peers. Lithium Argentina producing now, 40,000 tons is outperforming. So we continue to see value, so in Argentine brines on a relative basis, as you discussed. But I'm also just pointing out to viewers who have been watching us and you, Matt, in particular, flagging these relative valuation discrepancies they're coming to the fore as reflected in the scoreboard. So the past year, it's been fairly easy to make money. If you look at like all these producers, there's a lot of green, on a 1 year basis, on a 2 year basis. I'm sure, it's somewhat similar. And that's because lithium prices have risen so aggressively, right? And it's lifted all of those boats. Will lithium prices continue to rise? We'll see. But if they stay just at this level, a lot of companies are going to make a lot of money, and a lot more projects are going to be needed. And there's relative value to be found, on smaller stories, on the scoreboard. So with that, why don't we pivot to some of the other scoreboards, Matt?
Yeah, let's go with the minor metals one, maybe. And here we go. So the minor metals scoreboard covers a multitude of sins here. We've got titanium, cesium, high purity alumina, high purity manganese, high tech metals. We have antimony, scandium, and niobium. I like to start on scandium, which has actually been, very, very strong over the last month or so, and the prices similarly. And I mean, look at those performances. I mean, Sunrise 44%, Neocorp 35%, Scandium International 80%. Those are some pretty major returns there for 1 month.
Okay, Sunrise is backed by Robert Friedland, and I think that's a massive unicorn, 1.3 billion. If you looked at the 1 or 2 year chart for that, I think Robert was talking about that thing was up like 2,400%, last year. So, but so what's the momentum behind the scandium story?
I mean, I think the scandium price has been very strong, and I think a lot of these minor metals. I mean, we've talked about it before. These minor metals are the super cycle here. These high tech applications, these niche high tech applications, and these niche high tech materials that are just not known by many people in the market. And there's huge opportunities for these projects out there. I mean, the Sunrise, the increase in the market value of that project is so substantial because it effectively brings it into a range where they could now finance that project from. Whereas obviously for much of the last, 4 or 5 years when it's been in the doldrums, they didn't have enough value in the stock to finance the project. So, it's nice seeing some of these sort of niche projects going up. I should also make an honorable mention of the next section up there, which is Compine, which is a Belgian company which is active in recycling antimony, and it's actually the biggest Western producer of antimony outside China. And I should mention here for fullness that I do own stock in Compine, but it's a very interesting story insofar as there's nothing realistically outside China that's really in production in a big way for antimony. There's a few operators in Australia who produce it as a byproduct, but Compine is the biggest Western world producer of antimony at the moment from recycling. And there's a really interesting story to look into. It's, as with all antimony developers and producers, had quite a difficult period as prices have been quite weak over the last 4 or 5 months or so. But it's showing signs that it's starting to recover now.
What's striking about this, under antimony, the scoreboard, that's a very large number of explorers and pre-resource explorers relative to some other sectors. And if I'm looking at antimony, there's Perpetua, 3.4 billion, Mandalay, Alkane, 1.4 billion, and then a pre-resource explorer at US Antimony, 1.5 billion, right? I sometimes see these ticker symbols, the UAMY as a US listed one, is often tagged alongside MP and Energy Fuels and a few others, on my Twitter feed. But I don't know, I haven't played antimony at all. Could you?
Well,
why
US
are there so many?
Antimony is building an antimony smelter. So they're developing an antimony smelter in the States, and that's why I think that's why it's trading at a higher valuation than the rest of the sort of developers, as it were. But I mean, what's interesting about these sort of earlier stage companies is that a lot of these assets are quite close to surface. Some of them, particularly some of the deposits in Canada, etc., quite close to surface. They're quite high grade. Potentially, they could be mined effectively as a kind of DSO project. So if weakness continues or in the mining, or if China continues not to export material, then some of these could be brought into production quite quickly. Small amounts, but enough to sort of tide us over for a little while. So that's why some of these sort of mid-stage developers are of interest in the antimony space.
Do you think that's kind of the longer term play, Matt, is the whole, the geopolitical landscape has been turned upside down? Realistically, we're going to see a bigger commitment from governments and a more likely scenario where there is, production outside of China in reasonable scale.
Well, I think the really interesting thing about antimony and possibly the thing that's resulted in this big sort of investment universe is what we saw in antimony has been interpreted by many as a geopolitical thing. So China turned around and said, we're not going to export any more antimony. But it's actually a little bit more complex than that. China actually stopped exporting antimony to any great extent 6 months before it banned exports of antimony. And the reason is because demand in China was so strong that they didn't have any more antimony in their market to export. So antimony is effectively used, or it was used in China primarily in solar panels. And, the markets interpreted this as China, sticking two fingers up at the US, but it's not. China structurally changed from a large net exporter of antimony to a large net importer of antimony. And, for me, that's why antimony looks so interesting, because it's not just geopolitics here. We're actually seeing a structural change in the market dynamics.
But I guess, Matt, then that argument then should be, should Western economies in the US be reading the tea leaves on what other commodities China could fall short on a supply-demand balance, taking out geopolitics and getting ahead of the curve on it?
I mean, typically, yes, they should. How effective have the Western economies been in doing that in the last, 7 or 8 years, and indeed in the last 30 years of our careers?
Yeah, but I guess, the question then is, Howard's done some work on this as carrot and stick. If you have it as an incentive price and allow for a reasonable, operating cost and return, then only the good will survive.
I mean, I think there's a number of materials where I see structural changes in the industry off the back of this, high-tech cycle. And I'd like to see the Western governments becoming more proactive, trying to think ahead of the market. But at the moment, it's a huge educational issue, trying to educate governments and civil services and bureaucracies in terms of, just the materials we've got in front of us, like lithium and rare earths, and pushing into all of these minor metals. I mean, I think the other problem that, we have with governments that they can't quite get their head around is, they're very happy to deal with the Rio Tintos and the BHPs of the world. But, how happy are they to deal with the sort of the Sigma Lithiums and the Liontown Resources of the world, or even lower than that, with the lithium ionics and the critical elements of the world? How happy would they be to deal with those smaller companies? And obviously in these smaller commodities, where, they might be byproducts or very niche developers, how happy are the governments to actually talk to small companies? They don't want to really engage with small companies.
Matt, could you just scroll a little bit more before we turn to the rare earths? I just want to, so like, I'm looking at high purity manganese and high purity alumina, which are two areas you have flagged as of interest. And like, if I just look at the entire universe of high purity manganese, the market caps are, tiddly, right? It's ridiculous. And similar, like high purity alumina, the stocks, haven't been performing so well generally. And I also looking at like cesium, okay, you have PMET there, that's up a lot, but like Power Metals, Grid, right? Cesium was hot, for a period of time. Hyperion X and titanium has gone up.
Well, I think one of the big issues that we struggle with in a lot of these materials is the opacity. So, if I want to see what copper prices are, then I have a look at what the LME is doing or COMEX is doing. But it's much more difficult with some of these commodities. So if I want to know what high purity manganese prices are, well, I have to search around. There's a Chinese price that's available on SMM and some other areas, but there's no other major market price. If I want to have a look at antimony, it's even more difficult to get what the antimony price is. So I think, high purity alumina is another one. There's no quoted high purity alumina price. So the opacity of some of these, minor metals makes it very difficult for sort of investors to sort of get their head around what's going on. And I think that's an issue. In the high purity alumina space, the other issue is obviously that these are developers, and we all know how the Lassonde curve works, and it's very difficult when companies are in the sort of financing or construction stage, in terms of looking at performance. The same situation to some extent in high purity manganese as well outside China. So you're really looking for price action in the first instance, and then sort of support from the Lassonde curve as well. That's one of the issues that we're dealing with in many of these sort of minor segments.
Right. But those things could change, pretty quickly. Nobody was
Very
talking
quickly
about cesium before we were talking about cesium, and, Power Metals did very well last year. Since then it's fallen, quite a bit. Maybe it's the opacity, or maybe it's, markets have just moved on to other things. As we said in our webinar, I think last week, and again, I would encourage earlier this week, I would encourage everyone to watch that. These aren't, hold on for dear life, stories. You do need to trade and put in, maybe trailing, sell stops, because, things get hot for periods of time. Again, the opacity, can lead to that. I think high purity alumina is very interesting. Advanced energy materials, minerals, we need to kind of catch up with them again. They're trading below their IPO price a little bit, but I think they're in early stage production. They're not just a developer. And high purity manganese, like a lot of people have been talking about it with LMR coming on. Right, these are markets that could suddenly wake up. We could be looking a year or two in the future and see some 300, 500, even $1 billion market caps on these scoreboards, as we did in lithium when I started the first lithium scoreboard in 2015 or 16.
Absolutely, for certain. Yeah.
Okay, let's switch to rare earths.
Okay, so I think the first one to flag here is certainly USA rare earths, which is up 60% on the month. And I think a lot of that performance is off the back of the Serra Verde acquisition, which was announced recently. And that looks like a very, very strong acquisition. I mean, we commented on it briefly, I think last week in the recap, and it very much puts USA rare earths on the map. And if we scroll down and look at the performance of the iron absorption clay developers that are on the scorecard, you can see that the bulk of those, certainly the ones that were focused on Brazil, very much benefited from that. So, companies like Aclara and Viridis, Resuro did very, very well. Interestingly, Meteoric, which is also in Brazil, didn't do so great, but we saw a big move from some of these Brazilian focused players.
Okay, and as we mentioned earlier, a new play, which will, I guess, be on the scoreboard soon enough, is Rare Earths Americas, which has assets again in Brazil and in the United States, production resources. Okay, so rare earths. I mean, if I look at the rare earth scoreboard, there's a lot of green on the scoreboard. So there's still a lot of geopolitical tailwind attached to rare earths. We've talked a fair bit about, when will we see, the U.S. government talking, about batteries in the same way that they're talking about magnets, and the metals that go into batteries, as well as, the rare earths that go into magnets. And they haven't talked so much about it, although Tom Cotton, Senator Cotton of Arkansas, was in front of Chris Wright, the Department of Energy secretary, giving testimony, talking up Arkansas brine resources. There was also actually Doug Burgum posted on X yesterday that there's a ton of spodumene, all across the Appalachians going into Maine. And Ernie Scheider of Reuters said, will they ever build an open pit mine in Maine? We'll see. I've been aware of that for a long time. We thought one could get built in North Carolina, and Albemarle has Kings Mountain. So, but it's good to see that the administration is talking about lithium, as well as senators talking about lithium. But I think the Iran war, which is now 2 months old, has taken a little bit of the air out of the critical minerals discourse from the administration, which we saw big time, in January and February. So hopefully this war will be resolved soon enough. The markets are still a bit jittery, but they're climbing a wall of worry, and think that, it won't be so bad, but, who knows? But I continue to believe that the military budget, which is also Hegseth was giving testimony today, the Department of War secretary, and this should not be misunderstood, or underestimated. A increase from 1 billion to 1.45 billion, $450 billion, if that budget proposal gets through Congress, that's a huge increase in military spending, and that's a lot of metals that are needed of all types, and we'll keep keeping track of that, quite closely. Okay, and we'll just conclude with a question we weren't able to answer during the webinar. Someone asked, as an outsider to lithium and a real cheapskate, how would one look at the massive run-up in prices versus value still left in these stocks? I know it's case by case, but it would be helpful to understand.
I mean, I would say that obviously prices have come up a long way. They've come up sort of 2 or 3 times from where they were middle of last year. I would say that prices were oversold middle of last year, and perhaps maybe they're only double where they should have been. And generally in a commodity upcycle, prices will increase 2, 3, 4 times. And I think, if we look at the lithium supply demand work that we do, the notes that are being published by the sell side at the moment, the Canaccord note that came out this week, the UBS note that came out this week, they're all increasing their price forecast for lithium. I think there's considerably further to go for lithium prices in this cycle. There are some near-term risks on the downside, but interestingly, there are medium-term risks on the upside of much higher demand than perhaps the market's expecting as well. And if that's the case, then lithium prices still have further to go up. And if that's the case, then stocks certainly still have further to go up. So, it is on a case-by-case basis by stock. I think that the producers have done quite well. I think generally in cycles, you start to see the developers outperforming after the first run up by the producers. And then you also start to see the explorers as well. So I think, for me, I'm starting to look at the the interesting development stories and the exploration stories as well.
I guess, Matt, I mean, it's fair to say, basically having experienced a few cycles now in a short space of time, it is important, I think, for investors to assess, the timing and probability of a project going into production and when that will be. I guess if it's too far out, then you're running an increased risk of some form of correction in the cycle before you get there. And they're always cash-hungry companies. So, in the end, there's an implied lithium price in each of the producing companies, give or take, depending on how much mineral resource they have or mining resource. So maybe it's not a bad thing to have a bit of a buffer, or if it's not quite at where spot is, to give you a bit of room. But yeah, I think we're not overheated at these levels, I don't think. That's in agreement, because I guess there's so much going on, and some disruption to supply and demand on end products. But it doesn't feel like we've overheated like we have previously at these levels.
Yeah, I think my only caveat is obviously if the market falls out of bed, Western world recession concerns or whatever, they will throw the baby out with the bathwater. And it comes back to this point that Howard made earlier. I don't see commodities, at this moment in time as a, throw everything in and hold it for ages stock. I think stocks, you've got to be aware that there are other macro drivers in the market. And if, the market reacts in a bad way, then, lithium stocks will react in a bad way. But all other things being equal, yeah, I do think there is considerable further upside in the lithium space.
And if I'll just conclude, we'll flash up here. You referenced the Canaccord and UBS. We spoke at length about Canaccord's last week. UBS was the one that was making the rounds this week. And if I'm looking at their price forecast, they have upgraded their forecast, 23% near term and 17% long term. The long-term forecasts are really low, right? They've increased it from 1,200 to 1,400 for spodumene.
And I think the other thing with their long-term forecast is, to me, it doesn't quite make sense. When I look at the prices, they've got $18 per kilogram for carbonate and $1,400 for spodumene. Those numbers, they don't really make sense to me. So there's something not quite right in those numbers for me.
Yeah,
there's a margin shift somewhere in that makes sense.
And to be honest, long-term forecasts in lithium are it's a fool's errand. What matters...
we could do a whole... there's a lot of questions on X that I've seen, these long-term prices don't make sense and everything. We could do a whole episode on long-term prices and, how you formulate them, what they mean. Because I think the other thing with long-term prices that sell-side analysts use is they don't mean what a lot of people looking in from outside think they mean. So yeah, I think, but anyway, that long-term price deck doesn't quite make sense to me.
And I think you should, in general, history has shown you should ignore long-term price forecasts in, sell-side analyst research and focus instead on the short-term price forecast, which in this case, a 47% increase to $42,000 carbonate for 2027. That's a very significant number, 40,000. I heard that from SC Insights earlier this year. I think it was Baron Joey, at the end of December, really stuck their neck out, and they suggested, I think, 3,250 was their spodumene number, which was eye-poppingly crazy. UBS is now calling for 4,250 for next year. Okay, so if that happens, right, you're saying we haven't gone crazy as we went last cycle, but if these numbers start printing, there's a lot of upside here. And another thing I'll say is that UBS has been somewhat ahead of the curve here. They have we could point to this, like their new forecast versus consensus, right? They're saying they're 300% above consensus, which means there's a whole host of other brokers who have yet to upgrade their lithium price forecasts, and they're likely to do so. And as they do so, then consensus moves much higher, and they're telling all their clients, you got to get into some lithium, which means we're still in the early innings, I think, of this bull run for lithium. And on that note, we'll now talk about First Phosphate with John Passalacqua, and tune in till the end, and you'll hear Matt's comments with Amy Rotman, which cover CATL in detail. Thanks, guys. Today we're joined again by John Passalacqua, CEO of First Phosphate, a company we first introduced to our viewers in December when the stock was trading in the mid 80-cent range. Today, it's around $1.30, up roughly 50% from those levels and pushing all-time highs. Another good example of what we try to do here at RK Equity, identifying early, high-quality management teams in overlooked, not well-understood niche commodities before the broader market catches on. First Phosphate trades on the TSX Venture Exchange under the ticker symbol PHOS, and despite its recent move, it still has a market cap of only around 200 million Canadian dollars. In our view, the company's scarcity value, strategic alignment, and execution momentum could see it join the ranks of critical minerals unicorns over time. Recent research highlights a growing government-backed financing support, including export credit agency interest from both the U.S. and Europe, potentially covering more than half the project's sub-500 million capex, which materially de-risks the funding pathway. For those newer to the story, First Phosphate is a Quebec-based developer focused on high-purity igneous phosphate, not for fertilizers, but specifically for lithium-ion phosphate, or LFP batteries, which are increasingly dominating energy storage, data centers, and electrification more broadly. As we've said before, don't forget the P in LFP. Earlier this week, the company announced results from its 40,000-meter infill drilling program. Matt will dig in shortly on this and other key steps as the project transitions toward feasibility and further de-risking through 2026. We'd also like to point to a research note from recent Rockstock channel guest Dimitri Silverstein at Water Tower Research, who we met through the Metals Company. Dimitri highlights that phosphate is the largest material component in LFP batteries, yet remains one of the most underappreciated inputs in the entire supply chain. Only a small portion of global phosphate is suitable for battery-grade applications, and a localized North American supply chain remains largely undeveloped, positioning First Phosphate as a potential first mover in what could become a real bottleneck material. Dimitri also highlights the stock is still trading at less than 10% of its underlying project NPV, highlighting a significant valuation disconnect even after the recent move, which is really the crux of the First Phosphate investment case, a pure-play, vertically integrated North American phosphate platform, aligned with government policy and supply chain reshoring, in a Tier 1 Quebec jurisdiction, with early proof of concept, partnerships, and now binding offtake traction. The company is targeting a feasibility study by the end of 2026 and potential production by 2029, giving investors a clear line of sight to execution milestones. If you'd like a copy of Dimitri's note, please feel free to reach out to us at rockstockchannel@rkequity.com. And as always, a quick disclaimer, RK Equity is a strategic advisor to First Phosphate and holds equity interests in the company. This discussion is for informational purposes only and should not be considered financial advice. Please do your own research and read the disclaimer at the end of this video. And with that, welcome back, John. Matt's here with me to dig in with some questions.
Yeah, great to be here. Thank you, Howard.
Okay, hi John. So I think the first thing to talk about is the drill results, the assay results that you released recently. Some pretty interesting numbers. It's infill drilling. over 100 meters at 8, 9, 10% P2O5. Pretty high grade results. Can you talk a little bit more about the drill results?
Yeah, so the drill results, Matt, were really important, basically to determine the continuity of the resource. So we've been able to determine that it's consistent, it's continuous. We also found a couple new higher grade areas, both extensions towards the east and also at depth. So now the next step is under 43-101 is to update the mineral resource estimate. And we're quite comfortable that we should be able to move quite a few of the resources from inferred to indicated, up to indicated and measured. But obviously, we can't say anything until that process is complete here in the next couple of weeks, where we will be putting out a new mineral resource estimate along with a new 3D geological model.
Okay, and just remind me, what sort of depth have you drilled to on the existing resource, and are you going any deeper on the new resource, or is it a similar sort of depth?
Yeah, look, the existing resource was kind of like 250 to 300. We've gone down with some holes, down as deep as in the 400s. We'll have to see how much of that can actually, fit into the pit, before the waste rock becomes too much. We had a 1.5 to 1 strip ratio under the PEA, which was phenomenal. So we want to keep to those very good ratios and see how much more can be had. But I mean, the most important point I just want to, really drive through to everybody. The infill drilling was really to move the resource from inferred and indicated up to indicated and measured, which then allows us, to get into the next steps of resource development, like a feasibility study, permitting, and eventually an open pit mine. So any kind of bonus on the resource grade and any kind of bonus on the amount of resources is exactly that, a bonus.
Okay, and just remind us when you are expecting to get the MRE calculated by.
Yeah, in our last press release, we said it should be in the next month, being sometime in May. So expect that by the end of May.
Okay, and just sort of to remind the viewers, can you talk a little bit about the geology of the deposit and why that is different to the geology of other phosphate deposits?
Right. So really important, Matt. So this is an igneous deposit. Igneous meaning it comes from volcanic rock, as opposed to other phosphate deposits, which are sediments from old organic matter that kind of accumulate at the bottom of swamps or seabeds or ancient seabeds and that. So igneous is really important. It's kind of like phosphate that was trapped in the lava millions of years ago. So igneous phosphate reserves are only 5% of the world's phosphate, and they're the purest, right? Because it's caught in the lava. It's not caught in the sediments of sedimentary rock where you've got a lot of the nasties in there like cadmium, uranium, and thorium, which just cannot be separated to a certain point. And that's really good for fertilizer. But this really high purity igneous rock is good for high purity, such as what the batteries require, the LFP batteries require, which are now almost 80% of batteries on planet Earth that are produced out there. But within the igneous deposits, which are 5% of the world's phosphate, there's 1%, so 4% are carbonatites, which are very pure, but some of them have issues along with rare earths and they're hard to separate. There's only the carbonatites that come out of basically Northern Europe, mostly in Russia, which are now under sanctions, which have been able to be separated and get up to a grade of 38 and change P2O5. But there's something really exceptional in Quebec. It's this one geological province just around the Saguenay-Lac-Saint-Jean area. And it's got 1% of the world's phosphate that's igneous anorthosite. So it's igneous, but it's not caught in a carbonatite. It's caught in an igneous rock, and it's exceptionally pure, and it's exceptionally easier to separate. So we separate out magnetite, ilmenite. We recover about up to 92% of the phosphate that's trapped in the volcanic anorthosite, and we're able to upgrade that up to a 40 to 41% P2O5, which is almost pure apatite. It's just basically calcium and phosphate together with a few other sub-elements. So that's really the beauty of this igneous rock, and it just processes very clean into purified phosphoric acid, which then goes into the battery. Almost 90 to 95% of this rock goes directly to purified phosphoric acid. And you don't even touch the fertilizer industry. So we're just basically, perfect rock for the technology industry, not having to touch the commoditized fertilizer industry.
Okay. And sort of just to come back onto that, I mean, obviously with battery production, it's more about impurities as much as the purity of the product. And what's attractive about this rock in particular is it has very, very low impurities, particularly when processed. And what sort of impurities are you picking up in sedimentary grade phosphate rocks that are sort of deleterious to battery production?
Yeah, so every deposit is different around the world, but if you look at the sedimentary deposits, there are quite a few of them in the world. They represent 95% of the known phosphate reserves. The for the most part they'll be higher in sort of the heavy elements, cadmium, uranium, thorium. Could even be arsenic, lead, some of the other heavy metals. But it's all determined basically on the deposit type. But most of them have some form of radioactivity in there, which makes it difficult because when that's even processed up to this fertilizer grade agricultural type phosphate, the gypsum slag that's left over after that is radioactive and cannot be reused. Whereas the gypsum that's produced in the igneous route is reusable because of the low radioactivity. And that's key because there's a big problem with the gypsum slag piles all over the world now. Due to the increased need for fertilizer, to feed the world. Can't feed the world anymore without phosphate.
Okay, excellent. So, I mean, really, this is a very differentiated project geologically. One of maybe 1% of phosphate deposits in the world, and it's very strategically located in Quebec, able to supply either the European market or potentially the US and Canadian market.
Yeah, correct. I think when you start looking at the lithium space and maybe even the graphite space, there are it's not plentiful, but there are a lot of potential uh, explorations and mines in lithium that could potentially come online. And a lot of them, are it's a question of what's more economic or not. But when you come into igneous phosphate, and the requirements for batteries, there really is very few of them. The only real deposits outside of Russia are in Southern Africa. They're hard to get to. In Brazil, they've got rare earths in them, so they go into the fertilizer industry. It's so rare, this igneous phosphate, especially in North America. It's only in one region as far as we know. And we've got, the largest amount of claims. And we've got the deposit that's, it's 70 kilometers from deep sea port. That's easily accessible. So we've got a very special, very rare phosphate. I would say it's even rarer than lithium, and it's in a position where it can be exploited with minimal infrastructure built.
Brilliant. Okay, thanks very much, John. We look forward to seeing the MRE in hopefully a few weeks and get a little bit more details on where you go from here.
Yeah, that's great. Thank you so much, Matt. Thank you, Howard. Great to be here.
Yeah, I just want to say one thing. I think, John, you pointed out to me that in the cathode, LFP cathode, 4% of the cathode is lithium, but 60% of the cathode is phosphate. That's pretty crazy proportion.
Yeah, it really is, and I think, as the market sophisticates, right, now that we know that it's LFP battery leading almost 80% of the batteries on planet Earth, we really have to start drilling down into, the more sophisticated side of it, right? It's the lithium deposits are there. They're 4% of what goes into the LFP cathode, but where are we going to get the other 61%? It's like you can't build a battery unless you got all the components for it. So we have to start looking at some of the other components. So I think the moment on phosphate and high purity phosphate is starting to manifest, just like it did on lithium, a decade ago, and just like it did on graphite, nickel, cobalt, copper, some of these other metals critical to the energy transition. In fact, the Canadian government for the first time put phosphate on the A list of critical minerals for the clean tech revolution. And they debated in the parliament. They specifically said, look, phosphate, there's a company in Saguenay-Lac-Saint-Jean, Quebec, obviously referring to first phosphate. That is phosphate, nothing to do with fertilizer, everything to do with the battery industry, 100% focused on the battery industry. So it's really important, I think, for investors to really start looking at, what's in these batteries. And when you look at LFP, I mean, it's so convincing. 61% of the battery, the cathode, is phosphate. And if people want to diversify into other elements of the technology and energy transition here, phosphate's definitely one to look at.
For sure. And I just also want to flag that the Fast Markets event is in less than 8 weeks away. Matt and I are strategic advisors to that event. And that used to be just a lithium event. Then it became lithium and broader battery materials. And John, you are a significant sponsor of that event. So if any viewers are going to be at the Fast Markets event, please reach out to us or John directly, and you can hear more about the story from him.
Yeah, that'd be great.
All right, John, have a great weekend, and thanks for providing us with this update.
Yeah, thanks to you and to all your listeners. Always a pleasure.
I'm Matt Fernley. I'm a partner at RK Equity and was formerly editor of Battery Materials Review and head of research for an energy transition hedge fund. I have a geologist by training, geochemist, and I've spent the last 20 to actually 25 years as a sell side and buy side equity and commodity analyst.
Okay, great. So you're very well versed within the battery materials, critical mineral sector. So thought we could talk just about some of the latest news that's come out in this front. So first of all, just looking at CATL recently came out with some news about some new battery chemistries. So wanted to get your take on, what you think about this announcement. What do you think about the batteries that they're bringing to market, and really how will this impact the overall batteries supply chains?
Sure. Well, I mean, I think the first thing to say is that this has been slightly misreported in many areas as one battery that can do sort of 1,500 kilometer range and recharges in 6 minutes. That's not the case. They've actually released a suite of batteries, one of which can recharge in 6 minutes and one of which can do 1,500 kilometers of range, but they're not actually the same thing. I mean, CATL is right out at the forefront in battery technology development. Them and BYD, the other Chinese company, far and away the most advanced in terms of a lot of the technologies that we see. And I think probably the four key elements that come out of this release. First of all, the fast charging battery. That's a sort of LFP chemistry. And LFP has been gaining really very substantial market share over the last 2 to 3 years. And I think it's probably fair to say that LFP has knocked a lot of the mid-nickel and some of the high-nickel batteries out of the market. And that has contributed to slightly lower than expected nickel demand growth from the battery industry over the last 2 to 3 years. So that's the implications of that. LFP continues to gain market share. High nickel will have a niche in premium EVs and in some sort of non-car applications of batteries, like sort of military and defense applications and other areas like that. But it's probably not going to be sort of focused on the mass market. Interestingly, and talking about the premium applications, then the other battery that was of interest in the CATL release is this 1,500 kilometer range battery. And they actually state in the release that that is a high nickel battery. And I think what's very interesting there is a number of Chinese manufacturers, cell manufacturers, had been pushing to try and maximize range on NFP. And the fact that they've gone for this high range product being an NMC ternary battery seems to suggest that we've got as high as we can in terms of energy density for LFP. Pushing for a 1,500 kilometer range makes the battery in the vehicle too weighty, too heavy, and that will impact the efficiencies of the vehicle. So I think that the fact that their high range battery is an NMC battery probably says we're probably close to the max in terms of energy density for LFP. So I think that's great from the point of view of non-LFP battery use. The other area within batteries that's getting a lot of common column inches at the moment is the sodium-ion debate. And we got a lot of people in the industry going, well, is sodium ion going to take over from LFP? Is it going to replace lithium ion? For me, not in the near term. And the reason that I say that is twofold. First of all, sodium ion is a number of years behind LFP in terms of energy density. And the second thing is that the supply chain is not well built out at the moment. So I think, that sodium ion is going to be helpful on the margins of the lithium-ion industry,
but I don't see it destroying demand for lithium ion at this point in time. I mean, a lot of fuss is made about it sort of taking market share in the ESS market, which has been one of the fastest growing markets in batteries over the last sort of 6 to 12 months or so. But those who are talking about it don't seem to realize that because of the energy density drawbacks of sodium ion, a sodium ion cell would be probably 50 to 60% larger than a lithium ion cell for the same energy power. Realistically, it doesn't seem that we will see ESS, replacing LFP with sodium ion. The only caveat for that would be if lithium prices go too high. So if lithium prices spike again, like they did in the last cycle, then we could see demand destruction and a move into sodium ion for the ESS space. But I don't really see sodium ion taking over in the EV space. And then the final point, which a lot of commentators haven't picked up on, which I think is very interesting, is this issue of battery swapping. And I raise this because obviously when we talk about sort of EVs and demand for batteries and everything, we primarily talk about cars, passenger vehicles. But one of the highest growth areas over the last 6 to 12 months has actually been heavy commercial vehicles or commercial vehicles. One of the issues around commercial vehicles is because obviously it takes so long to recharge a battery, or it has done historically, that using lithium ion for commercial vehicles has been sort of negated. But increasingly, with these new fast charging technologies coming out, it becomes much, much more viable. And one of the technologies that CATL is pushing is battery swapping. Now, we've heard battery swapping in passenger EVs, particularly with NIO, which is a Chinese maker that uses battery swapping. But CATL is bringing it forward in commercial EVs as well. And that's relevant because you don't have to worry about recharging these big, big batteries. I mean, these batteries probably in a commercial vehicle, maybe we're talking 300, 500 kilowatt hours. That's probably 5 to 10 times the size of a battery in a passenger EV. So these are big, big batteries, and they're heavy batteries, and they require a lot of power, voltage to charge these batteries. And that's very difficult unless you have a connection to the grid. So you could get around this by using battery swapping, and then you can replace the battery in 5 or 10 minutes. And then the vehicle can go on with whatever it's got to do, whether that's long distance transport or whether that's sort of transportation on a route and then coming back to a fixed point. But I think this battery swapping is very important because if it takes off in a big way, it could mean that batteries in commercial vehicles take off in a big way. And these are much, much bigger batteries than we see in passenger EVs at the moment.
Okay, very interesting. I mean, definitely quite a bit happening within that one kind of big news article,
Yeah.
happen. So you talked about kind of the potential for lithium price spikes based on these kind of changing chemistries. What are some other kind of commodity specific impacts that you think could potentially arise from changes in battery chemistry and kind of just changing ideas about what's needed within EVs and ESS?
Well, I mean, I hope that we don't have any commodity price spikes. I mean, I think probably the industry is pretty happy with prices where they are compared to where they were last year. Probably 3 times where they were last year in some cases, maybe 4 times that in the cases of spodumene concentrate. So I think the industry is pretty happy with the fact that it's making lots of money now. I mean, it's not really in the industry's interest for prices to spike to the sort of levels that they did in the last cycle, because that would result in a lot of demand destruction. But we do have this environment at the moment where the significant acceleration in ESS demand cleared out cell inventories and lithium inventories in the system at the back end of last year. And we do have quite a lot of tightness, particularly in the raw material end of the spectrum. So the Spod con end of the spectrum in China at the moment. And if ESS demand remains strong over the rest of this year, and we have potentially a push on EV demand because of the high oil prices, that could go further towards tightening the market. So I'm pretty constructive on lithium prices over the course of the next year. I do worry about, in the future, the potential for more supply to come through. And that was what caught us out in the last cycle, when we were all sitting very happy and pretty and saying, well, this is a 10-year event. And it only took the Chinese 2 or 3 years to develop lepidolite and spodumene in Africa. So I'm wondering what the Chinese will have up their sleeves if lithium prices accelerate again. And I think probably there is a fair amount of supply available from Africa that could come in. So I'm wary about calling this as a 10-year event. But certainly over the next, 12, 18 months, I'm pretty constructive. I think prices are going to be cyclical. There's going to be strong times and weak times within the market, but I would expect the general direction of travel to be upwards. And obviously that's a great result for lithium producers, but also lithium developers.
Absolutely. I mean, on the topic of security of supply, we've seen some pretty major moves coming out of the US in the past year or so with initiatives to ensure supply of key critical minerals within the country and with friendly countries to the US. So thought we could talk a little bit about kind of this news on USA rare earths.
Yeah, sure. I mean, it's really interesting that we. I mean, the focus that we've seen so far from the US is really very much focused on rare earths. It hasn't really pushed out into other topics, but it's very clear that the US realizes that there's an issue in rare earths. And obviously in the last summer, Northern Hemisphere summer that is, we saw the MP deal with the US government and the price floor. Obviously this last quarter, we saw the Japanese deal with Lynas and the same price floor for NdPr. But one of the things that came out very clearly was, even though the US was happy to do the deal with MP Materials, that ore body that MP operates doesn't really have a lot of heavy rare earths. So it's not like Mount Weld, where there was a lot of heavy sitting around, but not stated in the resource statement until recently. There isn't very much sitting around in Mountain Pass, from what we understand. So this deal that USA Rare Earths has done to lock in the Serra Verde project in Brazil is a really landmark deal. And I think I wouldn't be the only person that suggested that their asset that they have in the US isn't, maybe a tier 1 asset. And the market value of the company is very high. So they've used their very, far be it from me to say, overvalued paper to buy what I do think is a tier 1 asset in Brazil with strong heavy rare earths output. So I think it's a great deal for them. A lot of people forget that USA Rare Earths also mopped out Less Common Metals, which is a rare earth refiner, which has operated for many, many years and has a lot of intellectual property in there. So they genuinely are making an integrated rare earth producer. And with this asset and the LCM asset, that makes for a very, very interesting story going forward.
Absolutely. Do you see this momentum continuing on? Any kind of thoughts on what we can expect next in the market?
God, I hope so. I mean, it's been a couple of difficult years in the industry, and it's always nice when stuff is happening. I am a little bit worried about the macro situation, particularly with the war in the Middle East, the high oil prices. I mean, I've never seen a situation where oil prices go this high and a consumer recession doesn't follow. So for the industrial commodities, I am a little bit wary, but I think lithium could buck that trend because of the higher oil prices and the demand for EVs. So I have my fingers crossed on lithium. I think in the rare earth space, it had been hugely undervalued for a number of years. And I think now with the government focus, the market is starting to follow the government focus. And then there's a lot of niche critical materials around, which are very much leveraged to this, call it a super cycle, shall we, in, high tech areas, which have never really been in focus before. I'm talking about things like antimony and tungsten, silica, other materials, which have, never really come onto people's radar screens, which are going to be very, very important going forward. So I think I'm a little bit wary about the outlook for base metals and industrial commodities, but I still think that there's potential for significant momentum in more niche materials.
Absolutely. Yeah. I mean, as you said, it has been a pretty good time for a lot of these niche metals recently. So hopefully that momentum continues.
Fingers crossed.
Yes, absolutely. Well, Matt, thanks for joining me here today at mining.com.